As we look at the screens today on Monday, January 5th, 2026, Opendoor Technologies is currently trading at $6.05 per share. The stock has seen a slight intraday dip of 0.25% during this morning's session on the NASDAQ. While that might look like a quiet start to the week, the real story lies in the massive volume shift we have seen over the last few hours. If you were watching the ticker early on, you would have seen the price testing the $6.15 level before settling back down into this range. Most people see a $6 stock in the real estate sector and assume it is just another victim of high interest rates. But what the broader market is missing right now is the massive increase in acquisition velocity that has quietly doubled over the last quarter. The general expectation for Opendoor has always been that it lives or dies by the 30-year fixed mortgage rate. When rates are high, the narrative says the company should be avoided because no one is moving. The reality, however, is that Opendoor has fundamentally changed its internal math to thrive in a high-rate environment. By moving away from holding massive inventory for months and instead focusing on rapid turnover and AI-driven pricing, they are proving they can generate a spread even when the housing market is sluggish. While investors are busy looking at the macro headlines, institutional buyers have been rebuilding positions in this company because they see the bridge toward profitability finally being built. This is not the same company that nearly collapsed during the housing price correction a couple of years ago. If you are using a Fidelity trading platform or checking your portfolio on the Robinhood app, you probably noticed that the volatility in Opendoor often mimics high-growth tech names like Tesla stock or Nvidia stock rather than traditional real estate firms like Realogy. This is because the market is starting to value the software layer of the business. During today's trading, the volume has been concentrated around the $6 support level, which is a major psychological barrier. If the stock holds this level through the afternoon, it suggests a strong base is forming for a potential breakout toward the $7 range. Institutional activity data shows that several large funds have been accumulating shares between $5.80 and $6.10, indicating they see this as a value zone. When you compare this to the wild swings in Apple stock, you can see that the risk-reward profile here is starting to attract a different kind of sophisticated trader. The recent movement is also a direct reaction to the leadership shuffle we saw late last month. The appointment of new executive talent focused on operational efficiency has given the market a reason to look past the old quarterly losses. The truth is, the company has successfully cleared out the toxic inventory from the previous cycle. They are now buying homes with a much wider margin of safety. If you are doing your own research through Interactive Brokers trading tools, or perhaps using an online investment platform like SoFi Invest, you will see that the spread between the buy price and the sell price has widened in favor of the company. This is the first step in proving their business model can actually scale without bleeding capital. For those of you managing your own wealth through a Fidelity brokerage or an individual brokerage account, it is worth looking at the technical indicators. The relative strength index is hovering around 55, which is firmly in neutral territory. This means the stock is not overbought despite the recent recovery. When we look at the daily range of $5.85 to $6.15, we see a company that is finally finding its footing. The market has spent years punishing this name for its SPAC origins, but the current price action suggests that the period of pure speculation is over. We are now entering a phase where the stock will be driven by actual unit economics and the ability to hit the profitability targets set for later this year. Comment below how many shares of Opendoor you currently hold in your portfolio and what your average cost basis is right now. It is always helpful to see how the retail community is positioned in these high volatility names compared to the big institutional players. Looking back at the foundation of this business, Opendoor was founded with the idea that the residential real estate transaction was fundamentally broken. For decades, the process was slow, expensive, and buried in paperwork. The company sought to fix this by offering an all-cash instant offer to sellers, providing certainty in an uncertain market. In its early days, the strategy was to buy as many homes as possible and hope that price appreciation would carry the margins. We all saw how that ended when the market shifted. But the current version of the company, often referred to as Opendoor 2.0, is much more disciplined. They have integrated heavy layers of machine learning to predict home values with a degree of accuracy that human appraisers struggle to match. This is why you see people comparing their data advantage to what is happening with NVIDIA stock in the chip space. Data is the new oil in the real estate market. The business model now relies on a product known as Cash Plus, which allows sellers to get the certainty of a cash offer while still having the chance to test the open market for a higher price. This hybrid approach has drastically increased their conversion rates. They are also working much more closely with agents rather than trying to bypass them entirely. By providing the Fidelity mobile app and other digital tools to agents, they have turned a former enemy into a distribution channel. This strategic shift is less capital-intensive and allows the company to maintain a much healthier balance sheet. If you are looking for investment help through services like Schwab Intelligent Portfolios or other investing sites, these are the types of fundamental changes that analysts look for when upgrading a stock from a sell to a hold or buy. The institutional ownership now stands at roughly 30%, with major names like Vanguard and BlackRock holding significant positions. When you see these types of players maintaining their stake despite the historical volatility, it tells you that the smart capital is willing to wait for the long-term payoff. They are likely using sophisticated tools like the Interactive Brokers platform to manage these positions, looking at the long-term probability of Opendoor becoming the Amazon of houses. While that goal is still far off, the progress is undeniable. The net loss per share is narrowing every quarter, and the revenue per home sold is trending in the right direction. As we look toward the future, the primary catalyst for Opendoor will be the stabilization of the housing market. Economists are predicting that the 30-year fixed rate will settle between 6 and 6.4% throughout 2026. While this is higher than the historical lows of the past decade, it is a predictable environment. Predictability is what Opendoor needs to fine-tune its pricing algorithms. When the market is moving too fast in either direction, the model struggles. But in a stable, moderate growth market, the company can accurately predict its margins and turn inventory quickly. This is where the real value is created. If they can achieve their goal of becoming break-even on an adjusted net profit basis by the third quarter of this year, the stock price will likely be trading at a massive premium to its current levels. There are, of course, significant risks that any investor using a Robinhood app or Fidelity IRAs needs to consider. The housing market is notoriously sensitive to geopolitical shocks and sudden shifts in employment data. If we see a sudden spike in unemployment, the demand for housing could crater, leaving Opendoor holding homes that are declining in value. However, the company has built a much larger cash buffer than it had in the past, with a current ratio that suggests they can weather a significant storm. They are no longer the fragile startup they were 5 years ago. They have gone through the fire and have come out with a leaner, more resilient structure. When you look at the landscape of online investing today, there are many options for where to put your capital. You could play it safe with Fidelity mutual funds or diversify through Fidelity ETFs. You could even look at more stable tech names like Apple stock. But for those who have a higher risk tolerance and are looking for a company that could fundamentally change an entire industry, Opendoor remains one of the most interesting plays on the board. The contrast between the expectation of a failing iBuyer and the reality of a growing AI logistics platform is where the opportunity lies. The market is often late to recognize these transitions, and by the time the profitability is confirmed in the official filings, the stock will likely have already made its move. Self-investing requires a deep look at the numbers, and the numbers for Opendoor are starting to tell a story of recovery. They have reduced their quarterly overhead significantly and are doing more with less human intervention than ever before. This is the core of the strategy led by the current management team. They are betting that they can replace expensive human processes with software and automation. If this bet pays off, the margins will expand in a way that traditional brokerages simply cannot match. This is why the stock attracts so much attention on social media and among retail traders using the Robinhood trading platform. It's a classic story of a fallen angel trying to earn its wings back through cold, hard execution. In summary, the state of Opendoor Technologies at this very moment is one of quiet transition. The current price of $6.05 reflects a market that is still skeptical, but the underlying data suggests that the skepticism may be misplaced. We have seen a doubling of acquisition volume, a narrowing of losses, and a strategic pivot toward a less capital-intensive model. The old expectations of a company that would be crushed by interest rates have been met with the reality of a firm that has learned how to navigate them. Whether you were